Hello and welcome to Hot Money on BloombergQuint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts, Kalra, founder of Target Investing, Avinash, Gorakshakar, Director of Research at Profitmart Securities, and Vineeta Sharma, Head of Research at Narnolia Financial Advisor, join me on the show. Many thanks to all of my guests for coming in today. Today on Hot Money, we'll discuss about the FMCG rally. Will it continue despite the expensive valuations of some of the stocks? Which are the best picks in this place? We discussed one large cap and one mid cap result that surprised our analysts so far in the quarter. And lastly, we talk about Reliance Industries, which is showing strong momentum today after being under pressure for the past couple of weeks. But let's start with the first one. FMCG stocks yesterday rallied anywhere between 5 to 7%. No doubt most of the companies have already reported numbers. It was mainly on account of the DDT that impacted and aided some of these MNC companies especially. But what's the view on this sector? Is there any stock that they like? Are they finding the sector valuations expensive? We'll ask our guest. Avinash, your overall trend on the FMCG sector, do you like this sector? Are you recommending any of the stocks to any of your clients currently?
In fact, Darshan, we feel that at the current level, stocks like Godrej Consumer and Dabur definitely have shown a decent kind of performance, both in terms of margins, in terms of the volume growth. And our sense is that, the Jan to March quarter could definitely be a better quarter compared to the third quarter. Already our sense is that some green shoots on the volume growth seem to be visible. And hopefully, in the budget, the kind of money which has been outlined for the rural spends is definitely going to percolate down to companies which have a large exposure on the rural market. So I think given a choice, I think Dabur and Godrej Consumer, obviously on market declines could be accumulated. Our sense is that the coming year could definitely be a better year in terms of volumes as well as margins. Okay,
so these are the stocks that anything that you are recommending your clients to stay away from in this sector?
Actually, Darshan, we track a very few stocks, but I think if you talk about Hindustan Lever, I would believe that valuations still seem to be a little pricey here. Our sense is that despite the fact that the results were slightly better than market expectations, the volume growth still has not kicked in to the level what probably our expectations were. So I think probably the higher kind of multiple or the higher kind of market stocks would possibly be away. We would prefer to go for the slightly smaller companies where we believe that probably both the urban as well as the rural spends could possibly drive their volume growth.
Okay, that's the view that's coming in from Avinash. Vineeta, what's your sense on this sector? Anything that, first of all, do you think that this rally that came in yesterday will continue? And secondly, what are the winners, what are the laggards according to you in this sector?
So as we already know that all the FMCG stocks are already at high valuations, and the volume growth that we have seen even in this quarter is more of because of promotions and one free, etc. So I think the prices have the price realization has kept the top line better. And once we see into the rural thing, the rural is still into pain. And I think from next quarter or the quarter next after, then only we can make a clear view whether the volume growth will be. But if 5 to 7% is the volume growth that we think that it will take the prices higher, I am not very confident on it. In between all these spaces, because all the FMCG are a good quality stocks, they have a good ROE, dividend payout. So I would not say they will be underperformers going forward. So they should be market performers. In the space, in the entire FMCG space, we're liking Hindustan Unilever. Two reasons. One is because they have a very, very good rural reach. And now they will be acquiring Glaxo, which will be merged in the next quarter. And once the Glaxo is merged, this is the only company wherein we will be able to see some top line growth because of acquisitions or whatever be the reason. We'll be seeing some 8 to 10% top line growth going forward. And rest, I don't see any meaningful volume growth or revenue growth in any of the FMCG companies, because already we, the unorganized to organized is the one which has helped the volumes in the past 1.5 years. Because if we look at the basic consumption, that has not gone up. For the listed company, it has gone up because of the shift from unorganized to organized. So that's my take. HUL should be the outperformer because of the reach, and once if the rural improves, it has almost 8 million reach Glaxo will add another 2 million. So I think that should
What
be
about the
perform.
food businesses? You've seen counters like Jubilant Food, Westlife, all of them rally because of numbers. Is that something that you're advising your clients, or that's something that you would tell them to avoid?
So from a long-term point of view, I don't see any, anything wrong into that company. But valuations, I'm still not comfortable. And I think looking at the inflation or even the employee cost going forward for these companies will be little tricky going forward. So that's my take on it.
Okay, Samir, what's your sense on the sector? You think the rally will continue? Any of these stocks that you've told your clients to start accumulating?
So I think rally can continue. Correction wise, we haven't seen much larger corrections over here. Time correction can be one part of the justifying the PE valuations in next 6 to 9 months. But there will be pockets which will outperform for sure. Like you said, Jubilant Foods and Westlife. The expansion of their past couple of years is now playing out in the SSG as well, and that footfall is helping them out. On the staple side, if I see Dabur is doing really well on again the expansion of the distribution and the product line. So that's really helped them sustain that kind of a volume growth even on a higher base of let's say 15 to 20% which was there last year. For me, I think right now Dabur, Jubilant Food and Colgate. So for me, Colgate becomes a priority list and Dabur in the staples. Colgate, given that premiumization takes much more faster pace and they are able to maintain their market shares. Though the volume growth is 2%, but again, I think on the reach which they have, it's going more direct, so they are able to have a premiumization play much better over there. That's helping the margins and the profitability. So I think that's a better play. On the Dabur, I think the volume growth play is much better as compared to a HUL or a maybe right now any other Imami or anyone else. So I think it's better to be placed in these two rather than anything.
Okay, that's the view that's coming in on the FMCG sector. The next one is basically, we'll keep it open-ended. We're in the midst of earnings season, almost more than halfway through into the earnings season. We ask our guest whether they find any large cap number that surprised them. It could be either positive side or negative side, but the result was something that they didn't anticipate, and it was a big surprise for them. Vineeta, which was that number? You must be analyzing a lot of numbers that come out. Which large cap probably you found surprising?
So one large cap which I found surprising was Bajaj Auto, given the margins that the Bajaj Auto delivered, and the volume has already been what we are seeing is coming out well. The export is contributing very well to the top line for Bajaj Auto, and that is keeping the revenues as well as margins on the better side going ahead. Also, if we look at the KTM sales, which contributes around 10% to the PAT of Bajaj Auto, that recently there has been some slowdown in the volume, but going forward, the way the management is putting more quality efforts going forward, so Pulsar and the KTM bikes will be the one which will be having more of the technological changes going forward. I think Bajaj Auto, from revenue point of view, it has very well diversified itself. So once the domestic slowdown is coming into the country, so Bajaj Auto is able to mitigate it through its export sales. So some part is not performing well, like Bangladesh or Sri Lanka. There is some issues, but overall, I think with the new product launches as well as catering to the newer market, Bajaj Auto should perform going forward. Also, it should perform well. Yeah, there is one news which I just came to know that there is
the Nigeria
yeah,
one.
the Nigeria. So there has been some ban from the government from that side that we need to analyze, because Nigeria right now it contributes 4 to 5% of the total sales for Nigeria. I mean, particularly the Lagos city. So that contributes around 4 to 5% of the sales. And what this ban is, particularly on the taxi front. So there are a good amount of sales which is coming from the personal sales also. That we need to analyze. But in the auto space, I think on the large cap, Bajaj Auto has been a good performer.
Okay, Bajaj Auto is the one that surprised. Samir, which was that result that surprised you?
So I think for me, on the negative side, HDFC Bank was there. The provisions were higher, the asset quality quarterly is sequentially also going off. and the unsecured book is becoming larger even after the asset quality concerns by everyone. So that is one thing I will be really, taking closer look into, and I might take out some profits also, even if I'm a long-term investor, because given the management change hangover also there, so there are a lot of things which are on the ground changing for the bank. So it's better to book some profits and keep a hold to rest of the balance.
Okay, but HDFC Bank, so somehow disappointed on the negative side, and Avinash, which was that stock that probably surprised you or disappointed you?
No, I think on the surprise side, which actually pleased our expectations, was Tech Mahindra. I think the numbers were much better than what the street and our expectations were. Although margins were down, revenue growth sequentially was pretty strong, around 4% plus, and I think the deal pipeline is pretty strong. They've already won deals worth about $1.23 billion, and from the management conference call, one thing was very clear, that enterprise and communications is now going to be a very growth kind of trigger. The margins could remain softer for one more quarter, but hopefully FY21 is going to be a lot better. So our sense is that typically with these kind of deal pipelines looking strong and the enterprise business again getting ramped up, I would not be surprised that possibly we could see some sort of margin improvement in FY21, which I think the market is also waiting for a long time.
What's your pecking order in the top 5 IT companies, be it Infy, TCS, HCL, Wipro and TechM?
I would believe that I think from the larger space we still continue to have a higher degree of comfort on TCS. I think TCS would figure out first, then Infosys, and obviously within the smaller ones we like Tech Mahindra. I think Tech Mahindra definitely, looking at the numbers, looking at all the other IT players from the smaller pack, Tech Mahindra definitely has done well, and I think the management commentary, Darshan, appeared to be pretty positive and solid.
Okay, that's the view that's coming in on the stocks on the large cap front that surprised the street or disappointed. Now, we'll talk about the mid-cap end of the market. A lot of companies probably will feature in this list, but Samir, one mid-cap stock that surprised or disappointed could be either.
So I think for the positive surprise, JK Lakshmi Cement numbers surprised me, though the volume wasn't that higher, but still given the capex they are doing and a lot of cash flows which were outgoing, the profitability and the EBIT margin expansion was pretty much surprising, because the pet coke utilization went up for them. So that's where even I think this company can really do up well, because they have added a new line of clinker unit, around a 1 million ton per annum. So that will help the volume growth as well, because their capacity utilization is around 75 to 80% right now. And this capacity is coming towards the west and the north to serve, where I think volume is there, but the pricing power is now coming back. So I think this can be a real trigger for JK Lakshmi.
Okay, among the other cement companies that came out, what differentiated JK Lakshmi compared to, let's say, an Ultratech or some of the other smaller companies?
So I think the whole, if you see Ultratech, comparison wise, their integration is doing well. So the positivity is there on the large cap end. But again, the capacity utilization is still lower on a larger sense of system. If you see others which have come out, the only main problem which I see with them is, even after a slight recovery in prices which will come in, their costs haven't gone down drastically. If you see especially the south ones, their costs are still high. Ultratech was able to substantially lower because of the pet coke expansion and the fuel cost as well. So others are not able to do that, where JK Lakshmi was able to pull the same kind of a trend, let's say, in that sense. So I think it's better off to be putting over there.
Okay, Avinash, which was that number that surprised you on the mid-cap end or disappointed could be?
No, I think on the mid-cap side, what surprised us was, a small player called Thyrocare, from the diagnostic space. I think despite the fact that, competition has increased, what was surprising is that we saw a good 300 basis point expansion on the diagnostic part of the business. And despite the fact that top line grew by just about 11-12%, EBITDA growth and the bottom line growth was pretty strong, almost 23% on the EBITDA and 32% on the profit. The management con call also mentioned that they are looking at a very strong Q4 number, and hopefully the imaging business, which was the underperforming segment in the third quarter, should also pick up. Overall, I would believe that despite the fact that they are still a small player, probably some more stronger top line growth could come in probably in the year FY21, and the new businesses which they are seeding, hopefully that should also contribute to the overall expansion to the profits.
They massively underperformed Dr. Lal and Metropolis, despite being cheap in terms of valuation as compared to them. You think it's time to shift position, if someone has positions, to shift from, because Dr. Lal has already reported numbers which were not all the best. It's time to switch from them to Thyrocare?
I would believe that, in terms of valuations, Darshan, the scope for re-rating on Thyrocare looks pretty good, because both Dr. Path Labs as well as Metropolis, if you look at it, definitely are richly valued. And despite the fact that growth is definitely continuing, this is also a B2C business. And frankly, our sense is that if the company continues to maintain its margins and, goes on to, increase its top line growth, then the markets would definitely be pleased. This is an older player, but obviously, as you rightly said, the stock has underperformed. So markets could possibly watch the March quarter and then what kind of growth comes in FY21.
Okay, so in fact, all three of them have outperformed in the last 6 months. 60% for Metropolis and Dr. Lal, and a 40% move on Thyrocare. And remember, majority of the move, 20-25%, will have just come in the last 1 or 2 days post the numbers. So Thyrocare is picking up, and Dr. Lal slightly coming off post the numbers. Vineeta, which stock on the mid-cap end did you find that surprised you?
So one stock that surprised us was McDowell, and we are already having, we have already asked our clients to have McDowell in their portfolio for 2 reasons. One was that we were expecting some kind of premiumization to play in, and that from a long-term perspective, that is set to happen. But then we have seen in this particular quarter that all the prestige and above products, the volume growth was better than the popular segment. So that shows that going forward, premiumization will play, and that will help the margins going forward. On the gross margin side, certainly there were pressure on the ENA prices, but that has cooled off a little bit. And I think if we compare globally also, we are quite underpriced. The second part of what the United Spirits volumes can contribute going forward is the bottled in origin. So that part is still a lot more to grow from here. But if we look purely from the premiumization side, the margins have improved and the volumes are coming that way. On the cost front, they have undertaken slew of measures, like, once they changed from the route to market that they changed, and there were a lot of franchisees because of which they had to have a lot of cost into their books, I think. And also a lot of the factories at the ground level, they have done a lot into mitigating all this costs. So I think going forward, the operating margins will, the cost will also improve, as well as the average realization should also go ahead going forward.
What did you make of the conference call commentary that the management gave? The stock had reacted massively post that.
So I think I didn't find anything negative into the con call, and they have been suggesting of a double-digit volume growth going forward, double-digit revenue growth going forward, and I think that is pretty much achievable going forward. So maybe from a 1 year, 2 year perspective, I think United Spirits should be a good stock to hold on.
Okay, that's the view that's coming in. United Spirits outperforming the peers on a 1 year basis. And the final stock is Reliance Industries, which has managed to smartly bounce back in trade today. Over the past few days, it had seen severe amount of weakness, but today the counter trading at the day's high, it's up almost 3%. So the rebound clearly been seen on Reliance Industries, up 40 rupees. What's the way ahead for Reliance? Avinash, Reliance, is a stock that you would recommend to your clients?
In fact, we have maintained a hold here, Darshan. I think if you look at the third quarter numbers, not very exciting, both on the oil petchem business as well as on the telecom business. And I think the markets which were clearly waiting for the Aramco deal to happen, I think possibly this may take a little more longer time, maybe for another 1 or 2 quarters. So our sense is that for the next 1 or 2 quarters, the telecom business is also not going to see significant amount of re-rating. The other companies have also taken significant price increases. So our sense is that somebody who has a long-term kind of view can definitely hold on. Wait for some further dip, probably you can add more, but definitely in the near term it could be a market performer.
Market performer on Reliance Industries. Any issues on the debt? Because that seems to be
I think
a lot of concern people have on that.
No, I think that was the key reason. The stock had actually earlier taken a good bounce once the Aramco deal was announced, at the time of the Reliance AGM. But I think hopefully, we believe that at least in the first half of FY21, this should materialize. I mean, it was due to happen in FY20, but I think, Darshan, this is going to be a big trigger once, obviously, Aramco puts in money. There's going to be a massive amount of debt repayment, which could obviously help the company. So maybe it's going to take another 1 or 2 quarters. After that, probably we could see a kind of a significant amount of re-rating.
Okay, what's your sense, Vineeta, on Reliance? Is that you all have this under active coverage? What are your targets? What have you recommended clients?
So, Reliance right now with BPCL coming up with the divestment plan, we are a little conscious on whether the deal with Aramco will actually happen or not, because it's a 60,000 crore divestment plan for BPCL, and Aramco deal with Reliance is going on some government interventions also. We are seeing government, and that deal is still unclear. So as Avinash said that for the last, from August when it was announced, from then we have seen some rally in Reliance, and that was probably because of the debt restructuring plan which Reliance was seeing with money pumping in from Aramco. So once that becomes unclear, and so obviously it becomes a very big hinge on how Reliance will perform. If we consider the Reliance Jio or the Reliance Retail, both of them are performing well. I would not say Reliance Jio is now 35.5% market share, top performer in terms of revenues. Even Reliance Retail, they are adding some 400-500 stores every quarter, and the SSG growth is around 8 to 14% in different categories. I think purely from business from our Jio as well as retail, that should give some cushion to Reliance, and I think people can accumulate it on fall, but not right now, because let the deal unfold and more clarity comes on into it. Once that uncertainty is there, it can change the balance sheet picture of Reliance.
Okay, that's the view that's coming in. Again, a hold on Reliance Industries after Avinash, even Vineeta is indicating a hold. And finally, Samir, Reliance Industries, how would you rate the counter?
So I think for me, two things are very important. The gas output, whatever the updates are coming, if mid 2020 is the year where the gas actually, the gas output really starts contributing to the numbers, then I think the oil and gas numbers on the quarterly basis can change. And second is the divestment. Now, whether that's Aramco deal, whether it's the tower InvIT being listed, I think the divestment on the whole is very important. So for me, it's a SIP mode stock. I won't buy fully in right now, but I'll do a SIP over here, just because the lower kind of dips which I get, it will be very difficult to judge on. So it's better to do a SIP and hold it for a long term.
Now, what's your sense? Any concerns on Reliance as such? One of them is debt. Secondly, is this Aramco deal?
So I think on that, if the global growth comes off, the volumes at the refinery end, if they start falling off, that becomes another kind of a very heavy negative on it, because they have done a large capex in last couple of years, and that capacity is already lower. Now, if it goes further lower, then your OPEX costs will increase automatically, and your operating leverage, which you are right now waiting for, gets delayed even further by at least 6 to 9 months.
Okay, that's the view that's coming in on Reliance Industries. I think it's a consensus hold or an SIP type of stock that's been spoken about. But with that, it's a wrap on today's edition of Hot Money. Let me thank my guests, Samir, Vineeta, as well as Avinash. Thank you so much for coming in today. Ask BQ comes up next. Stay tuned to BloombergQuint.